You notice that everyone around you, from the media to your colleagues, everybody's talking about artificial intelligence, AI, and how AI is revolutionizing various industries. So, you decided it's time to invest in AI companies to capitalize on this trend. However, instead of researching each company's profitability, their potential for long term growth, you simply search for publicly traded companies in the AI business and then throw your bets at them, even if some of these companies are losing money. This is availability bias at play. Money Arata. Availability bias is a cognitive bias where people tend to overestimate the likelihood of events based on how easy it is to recall examples or instances of these events. In our case, all the buzz around AI made the idea of investing in any AI related company to seem an attractive idea, and it might actually be leading you to overlook crucial factors like profitability and financial stability. Now, attention, this is not financial advice. Please read the full disclaimer before proceeding. Availability bias happens all the time in our lives. You just need to get better at noticing it. Here are three examples to make it very easy and memorable for you to understand availability bias. The first one is, hey, I know someone who won big in the lottery, so I should keep buying tickets. In this case, the availability bias leads us to focus on the single example of that lottery winner that we know rather than considering the overwhelming odds against winning. This biased perspective can lead us to spend money on lottery tickets even though the chances of winning are extremely low. Here's the second example. My friend invested in a hot new tech stock and made a fortune, so I should do the same. Now, when we hear about someone that we know who made a lot of money from a specific investment, it is tempting to believe that it is a sure way to make money. However, this belief is influenced by the availability bias as we focus on one easily memorable success story while we ignore the many other cases where people might have lost money on similar investments. And finally, the third example is, hey, my neighbor started her own business and became very successful, so I should quit my job and do the same. When we hear about someone that we know achieving great success in their entrepreneurial venture, well, it's also easy to believe that we can also achieve the same outcome. The availability bias here makes us focus on the successful example that comes to mind very easily, and we disregard the many other entrepreneurs who may have struggled or failed in their endeavors. In each of these examples, the availability bias causes us to rely on easily accessible information, memorable experiences to form our beliefs, rather than considering the broader context or more relevant data. See, you need real numbers, real statistics, not just the first story that your memory can recall. This hot company is going to do an IPO. Are you interested in investing? An initial public offering, an IPO, is the process of a private company becoming a public company by selling shares of their stock to the public. This allows people to buy a small piece of that company, buy shares in that company, and that gives the company the opportunity to raise money, to get money for their growth, for their expansion. IPOs often generate considerable excitement and media attention. They spend money to be promoting the IPO to get more investors. So it is important to recognize the role of the availability bias in shaping our perceptions about the performance of that investment. Many investors are drawn to the IPOs by the allure of getting it on the ground floor in this next big success story. However, the research shows that on average, these new stocks tend to underperform the market during their first year of trading. One reason for this discrepancy between perception and reality is that high profile, successful IPOs, they're more likely to be covered by the media and be discussed among investors. Examples such as Google or Facebook and Tesla, they grab headlines, they leave lasting impressions. They make us believe that IPOs are a surefire way to have big returns. This availability bias makes you ignore the fact that many IPOs lose value in their early days on the market. You are more likely to increase your wealth doing DCA, and you are more likely to lose your money to inflation. Due to the availability bias, we often have a distorted perception of risks in our minds. We overestimate the likelihood of experiencing a dramatic financial event, such as winning the lottery, making a fortune buying a hot stock at the bottom and selling it at the top, or losing everything because a complete market crash, a market collapse. These extreme examples are very easy to imagine. Now, at the same time, we underestimate the risks associated with more boring scenarios like not having enough money to retire, or the slow erosion of our purchasing power due to inflation, or just increasing our savings doing something very simple like a dollar cost average, a DCA strategy. You can see more details in episode number 8 of the Money Arata series to learn more about this boring but profitable strategy. The availability bias causes us to focus too much on shocking outcomes while downplaying the importance of less visible factors in our financial lives. Our brains are more likely to imagine the most exciting, the more extreme possibilities rather than thinking about the most likely or more common scenarios. Availability bias distorts your thinking. You need to take a break and do better research to think better. Let's take a step back and clarify what cognitive biases are. Cognitive biases are mental shortcuts that our brains use to process information quickly and make decisions without thinking too much. While these shortcuts can be helpful in some situations, they often lead us to make errors in judgment and irrational thinking. In a world of finance and investing, cognitive biases can result in suboptimal decision making, causing you to lose money, lose lucrative opportunities, or make poor choices that can result in losses. One related concept was the sunk cost fallacy that we already saw in the episode number 63 of the Money Arata series. Recognizing and overcoming cognitive biases is crucial for making better, smarter financial decisions and ultimately growing your wealth. By becoming aware of these biases and actively working to counteract their influence, you can develop a more clear, more rational thinking pattern, which can lead to informed choices and better financial outcomes. Don't trust the professionals. They are not immune to availability bias. Even financial professionals can fall victim to the availability bias. Financial consultants may not admit when they are not sure about a specific case. Instead of that, they might rely on familiar methods, familiar strategies, even if these are not the most suitable options for the situation at hand. Technical analysts examine historical price patterns and various indicators such as head and shoulders patterns and symmetrical triangles and the Bollinger Bands and the Relative Strength Index, the RSI. They use all of these to predict future price movements and make their trading decisions. Now, the problem is when these analysts are relying too heavily on these easily accessible and memorable patterns or indicators, and it goes worse when they overlook other important factors that could be influencing the market. They might become overconfident in their predictions, even though it is impossible to know the future with certainty. So if you are interested in a method that is mathematically guaranteed to protect you when you're doing your trading, you can visit arata.se/diamond hands. The availability bias can lead them to believe that because they've seen all those patterns, their indicators to work in the past, they will continue to work in the future, despite the inherent uncertainty of the markets. So to counter the availability bias in technical analysis, it is essential to maintain a healthy dose of skepticism and humility when you're making your decisions based on historical patterns, your indicators. It is also important to consider other factors, such as fundamental analysis, the macroeconomic trends, and also to be open to adjust your perspective as new information becomes available. You can overcome availability bias with a conscious choice on information sources. So how can we overcome availability bias and make smarter financial decisions? Here are 4 practical tips. Number 1, you have to diversify your information sources. When you're researching investment opportunities, gather information from a variety of sources to get a well-rounded perspective instead of relying solely on the current buzz or whatever is popular. Number two, conduct thorough research. Instead of making investment decisions based on a single criterion like the industry or the technology, you have to analyze each company's financial health, their profitability, their competitive advantages, and the potential for long-term growth. Number three, pause and reflect. Before making a financial decision, take a moment to consider whether your judgment might be influenced by recent or vivid or emotionally charged memories. This is why I highly recommend that you have a personal journal. You have to reflect every day whether there might be other factors, other opportunities that you're possibly overlooking. Number four, you have to use data and statistics. Have to base your financial decisions on objective data, historical trends, and this can counterbalance the natural tendency to overemphasize readily available information. By being aware of availability bias and implementing these practical tips, you can make more informed financial choices, you can increase your chances of growing your wealth, and minimize potential losses. Now remember, it is not about avoiding all biases because that's basically not possible. It is about being conscious of their influence on us, so you can think better, you can invest smarter, you can build a more secure financial future. In the case of availability bias, this means broadening your information sources, conducting thorough research, and not allowing the ease of certain information coming to you and dictating how you have to think about your investment decisions. And you can learn how to put all of this into practice by visiting the link arata.se/diamondhands.